If you're in the crypto space or the startup space or anything related to technology, honestly, the last couple weeks have been crazy with the collapse of FTX. Now, FTX was arguably the second or third largest crypto trading platforms in the world and was backed by some of the very best venture and private equity funds out there, including funds like Sequoia, Index, Ribbit, et cetera, et cetera, et cetera. They were a behemoth that was growing super fast. And Sam Blankman-Fried was like largely hailed as like the next Mark Zuckerberg. He's like brilliant kid from MIT that was like doing crazy stuff. He basically like supported cryptocurrencies like Solana from the grounds up and helped build that into a huge industry. Not only that, but he then went and invested in a ton of venture funds and startups. And at one point, he was like hailed as the savior of crypto as we entered the crypto winter, and all of these crypto-related startups started failing, like BlockFi, would come in and rescue them. And a lot of people were just looking at him and saying like, wow, this guy's like got it all. He's like knows what's going on and everything. And then over the last couple of weeks, like that whole house of cards came collapsing down. And the company went from a $36 billion valuation to, at this point, latest things I've heard is that there's like only a few $100 million of assets still left on the books that are liquid enough to actually be worth anything. So I thought it might be helpful to talk a little bit about, why FTX ultimately collapsed. There are a lot of similarities to what was happening at both Enron as well as Lehman Brothers back in the day. And so we're going to kind of bifurcate the two and talk about each one and the similarities here. So the first thing you have to understand about FTX is that as a crypto platform, FTX trades on trust, right? It's like a bank. Basically what happens is traders, right, individuals and hedge funds and so forth, they go onto the FTX platform. They deposit their cryptocurrency there and dollars in some cases, right? So they're putting money into the platform. That money oftentimes is converted into FTT, which was FTX's own token for their platform, just to facilitate trades and so forth. And then some of that money is, they use it to buy and sell different cryptocurrencies to move in and out of positions. And then, once they get in and out of a position, they may hold a bunch of the money on the platform to be able to quickly execute a new trade, or they may pull it off. FTX makes money by charging a fee on every time somebody buys and sells cryptocurrency, but then they may also offer additional services, like they could, allow people to borrow money to buy and sell crypto on margin. And they may offer, the ability to short stocks, which would require another form of lending. So there's a lot of different mechanisms there. But ultimately, what was happening was FTX was holding a bunch of this cryptocurrency, but then they were also putting it into different types of assets, different types of cryptocurrencies. And those other cryptocurrencies may or may not have been super liquid. And so you can't just dump all of the cryptocurrency at once. Because if you do that, then it'll force the price to collapse and go far down. And so you'd lose a lot of value. So not super liquid, right? Like you're kind of tied up. Well, what was happening on the Lehman Brothers side of why FTX collapsed was that they were operating under this situation of trust, where I go and I put my money on the FTX platform, trusting I'll be able to get it back out whenever I need it, right? The challenge, though, is that if everybody decides all at once that they want their money back, if FTX has taken some of that money and put it into less liquid assets or lent it out to others, et cetera, like that money's not there. And so similarly to a bank, the way a bank operates is I go in and I put my savings in the bank. The bank then takes my money, my savings, and they go and they lend it out to businesses. And they hold a reserve of, somewhere between 10 and 20% of my savings, me and everybody else's savings at the bank. So if I ever need to go in and get some money, they pull from that reserve and they pay me back. But if everybody went to the bank all at once, it'd be the run on the bank, and the bank wouldn't have enough money to pay everybody out. They'd pay out what they'd have, and then they would have to shut the bank down and wait for the loans to get paid back. That happened a ton of times, especially in the early days of our country. We had runs on the banks, and you had like the savings and loan crises and all these things. That's why the FDIC was created, to provide an insurance program so that if a bank fails, the federal government will step in and will pay you back up to, I think it's like $250,000 of savings to insure it so that people won't do a run on the bank. And you know, there've been a bunch of those mechanisms to protect banks. Well, in the financial crisis, those provisions weren't really provided to investment banks. They're only provided to savings banks, right? Deposit organizations. And so Lehman Brothers faced this really big challenge where they had a lot of these investments out there in mortgage-backed securities, essentially in real estate. And as investors looked at the space, they said, hey, real estate is going to decline, and we don't think that that's a good investment anymore, especially these mortgage-backed securities that have all kinds of flaws and issues. We want our money back. And so they basically had a run on the Lehman Brothers, like a run on the bank for Lehman Brothers, and started pulling their money out. The other issue is that Lehman Brothers then also struggled to raise money from other banks. So oftentimes what will happen is Lehman Brothers will go to these other banks, and you know, investment banks will go to other banks, so they're trading partners, and they'll borrow some money for them, and they borrow back and forth, and so on and so forth. Well, all of those other banks basically said, we're not lending you any more money, Lehman. We think you're a bad bet. And so Lehman couldn't get the liquidity it needed to provide to these other investors that were essentially making a run on the bank, and the entire business imploded and collapsed overnight. In that case, it was a much bigger business. I mean, you know, an order of magnitude bigger than FTX, but still nonetheless, the Lehman Brothers collapse really started that domino effect that led us into the Great Recession. And it wasn't that those mortgage-backed securities ended up being terrible investments. They just probably weren't worth what Lehman Brothers had marked them on their books at. There were a lot of people that came in and bought those mortgage-backed securities for, you know, pennies on the dollar, and ended up generating massive returns in the long run. Nonetheless, the same kind of thing is happened to FTX, where a lot of people are now demanding their money, and there just isn't any money to be had. And so that has forced the company into bankruptcy. Now, the piece about Enron that gets pulled in is that, unfortunately, it appears based on current data and what we know, and this is totally an evolving situation, is that the CEO, Sam, was also doing some pretty squirrely things. So he had this other entity called Alameda Research, and Alameda was essentially like this hedge fund that would go in and it would invest in other funds, it would invest in crypto companies, it would invest in tokens, and a bunch of these things. And a lot of people kind of were like, where are they getting their money from? How are they able to do all these different things? And a lot of people just speculated that, you know, Sam had made a ton of money through his own personal crypto trading and so forth, and that's how he was able to afford it. What they didn't realize was that essentially FTX was funneling customer funds over to Alameda, very similar to kind of what the Enron was doing, very much like fraudulent. And then they were taking that money from FTX and they were investing in all of these different things. And so not only was the money not there when investors came to get it and had this run on the bank, but then in addition, Alameda had made all of these super risky bets in different tokens and cryptocurrencies and crypto-backed startups were highly illiquid, and some of them didn't perform super well. And so they were losing a ton of money there, and they tried to prop up the FTT token when there was a run on it. So essentially you had all these things happen. What perpetuated all of this? What started this all? Well, there was a report that came out, but the word on the street is essentially what happened is that Binance, who's the number one player, has had a lot of regulatory issues, let's say, and a lot of skepticism about whether or not they are meeting, all the regulatory requirements. And what's interesting is Binance actually was an investor in FTX a number of years ago. FTX actually came back to Binance, I believe earlier this year, and basically said, hey, we want to buy you out. We want to buy out your position. Ended up generating a great return for Binance, but the way that they paid them out is they gave them $2 billion worth of FTT, the FTX's own token. And the belief there was that by giving Binance $2 billion of FTT, Binance would be incentivized to make sure that ultimately FTX was successful, because if FTX failed, that FTT would be worth nothing. But the reality is that Binance is a much bigger company. It's like 2x the size of FTX. And so when CZ, who's the CEO of Binance, heard rumors that Sam was going behind his back to politicians and regulators and trying to convince them to pass laws that would negatively impact Binance, CZ came out and basically said, we have real concerns over the stability of the FTX. Turned out to be rightly so. And he said, we're going to liquidate $500 million worth of FTT. Well, once they said that, they basically removed trust from the system. Everybody was like, oh crap, well, if Binance is liquidating their position, they don't have trust in it, I need to get out of this too. And when that started happening, then the price of FTT started to fall, because everybody was selling their FTT to trying to get out of it as fast as they could alongside Binance. Well, Alameda Research had a ton of money tied up in FTT, and they couldn't afford to have FTT collapse, because otherwise it would force Alameda and then by extension FTX to collapse. So they tried to prop it up by buying FTT at a set rate. But unfortunately, they kind of burned through all of their reserves that they could use to buy it. And as soon as it hit that, then the price of the token collapsed, thereby perpetuating a collapse of FTX as well. And they had to shut down all withdrawals and everything else across the platform. So, it's kind of interesting, because some have speculated that it was a bit of a hit job on the part of CZ. But I think the reality is that, yeah, CZ ultimately maybe was acting a little aggressively because he saw Sam trying to hurt his business from a competitive standpoint and kind of played that card. But ultimately, I think what really did Sam in was that he wasn't managing his business right. And that brings me to the last point I want to talk about around the collapse of FTX. And, I think the real reason that FTX collapsed was not because they didn't have a brilliant founding team, and they didn't have really great technology, and frankly, I don't even think like the real issue was that they were, doing these fraudulent things. I mean, ultimately, yes, that is a huge problem. But I think it really comes down to the approach that Sam and venture capitalists had on funding the business and capitalizing it. Chamath over at Social Capital, if you listen to the All In podcast, which is a great one, you should definitely go check it out, tells how they looked at the deal and they went back to Sam and said, hey, we think that, you should have some governance controls and maybe a board. And Sam basically was like, straight up was like, F you, I'm not doing that, right? And you're not investing in this round. And all the investors that were in, like, they didn't get access to, latest reports I heard is that they didn't get access to balance sheets. There was no board, there was no governance, there was no oversight. And I think you had a founder that like really didn't know what he was doing and thought it was okay to just kind of move funds around. And there was like nobody watching the house, right? And I think at the end of the day, that's ultimately why this collapsed, which is super unfortunate because, FTX has had a ton of promise. It was by far the best trading platform for traders, based on everyone I know that I've talked to in the sector. So, and that has nothing to do with the way that Sam ran the business from a technology standpoint. It was all in terms of all the stuff behind the scenes of reallocating cash to risky investments, and things like his back door and pulling out cash and giving himself loans and all kinds of stuff that probably would have been solved if he had really good oversight and a board of directors to ensure that things were run more properly. I think at the end of the day that, at least I'm hopeful, that this spells a return of a more balanced approach between venture capitalists and entrepreneurs. Over the last few years, tech investing has really, really swayed. I think that's driven by low cost of capital. So as interest rates are really low, there's a lot of cash available. As there's a lot of cash, a lot of funds have lots of money to spend and invest in entrepreneurs. They're all competing for the handful of the few deals that will become really home run successes at the end of the day. And when that happens, you're competing on valuation, but you're also competing on things like governance and oversight and how founder friendly are you? And I think that in many cases has resulted in situations like FTX where there isn't enough oversight, there isn't enough control, there isn't enough pushback on these entrepreneurs. And because they don't have anyone to be accountable to, essentially, they end up making mistakes that they otherwise wouldn't, both to their detriment as well as investors. Anyways, if this was an interesting video, check out some of my others, like Why There's So Many Layoffs, where I talk about how this current environment is resulting in more layoffs and what to expect in the future. Thanks.